the Fed had a hard job before the war came up. There are a lot of problems there. Now they got the war on top of it. In a nutshell, it's a favorite game. How are they doing?
You know, David, I mean, listen, and I think Chair Powell alluded to the fact that they should have moved earlier. I mean, we're in it, you know, the Fed is behind the curve, significantly behind the curve. You know, now I think what's really tricky is how do you move to the other side quickly and not disrupt the system so aggressively? So I think they're in a tough spot. In fact, I think this is the toughest spot I've seen a Fed in maybe in my career. And so listen, I think it's going to be a challenge. I think you've got an economy that, you know, I always say this: high prices are the cure for high prices. You're actually seeing an economy that's starting to moderate in a number of places, and I think the Fed has to try and be careful about not letting the economy slip into a recession while they're trying to deal with inflation. Listen, much of this inflation is supply shock driven. You know, when you go through some of these, you know, we talk about energy a lot. You know, the global wheat production, 34% comes from Russia to Ukraine. Pretty incredible numbers. You're going to see that flow through of food prices. So it's a challenging dynamic that's going to impact the economy for sure. And the Fed's got to straddle a very fine line.
So, as you say, Rick, high prices are said to be the solution for high prices. I'm going to put up a chart here for our television audience. We'll describe it for those of us joining us on radio. That basically illustrates that point in terms of real consumption, not nominal consumption, but real consumption, and the extent to which really inflation at this point is outpacing the growth in consumption.
It's pretty incredible, David. I mean, we went through this period, you know, with an explosive set of real growth of quantities, real growth of goods demand, that as you emerge from the pandemic, people are buying cars and furniture, et cetera, I mean, across the board, electronics, computers, et cetera. Then now you get this spike higher in prices. And what you're seeing is a pretty extraordinary dynamic that now real consumption is starting to come off, i.e., the cure for high prices, people start to pull back on demand. You're seeing this in inventory builds. Retailers are growing in terms of, you're seeing inventory start to build. That will bring prices down. But it's definitely something to pay attention to. I think I have one other chart that shows the dynamic that where we are today in consumer sentiment. Consumer sentiment's the lowest it's been in 10 years. You know, desire, a good time to buy a car, a house, durables, are really falling precipitously. So, you know, this is part of that dynamic that the Fed has got to straddle this line, and the consumers are gonna pull back. I mean, look at these numbers. I mean, it's pretty staggering. By the way, you're talking about these numbers falling off a cliff when the consumer is arguably in the best shape I've ever seen them in history. Savings rate is up, wages are up, hiring is up, and yet they're going to pull back and they're going to wait because these prices are eye-popping high, and are going to wait for a better period of time. Particularly when you look at the consumption basket for lower and middle income, right, fuel and food, shelter, where you're seeing the biggest price hikes, it makes it really tough for consumption to stay up.
I want to come back to the lower and middle income, but before that, just interpret that conditions chart for me just a little bit, Rick. Is that demand destruction we're starting to see?
That's exactly right. I mean, it's literally the dynamic. By the way, you're seeing this in corporate earnings. It's interesting. You see a lot of companies now, and they're reporting their revenues are still decent. But then when you actually dissect their revenues, and you get a dynamic where, wow, they're not getting it from quantity anymore. They're getting it from price. There's a limit to how much you're going to get that. And this is part of why earnings can start to come off over the next couple of years, because you can't keep getting it through price. You got to get it through quantity as well. By the way, when you look at what the Fed did in terms of their projections this week, they dramatically brought down real GDP. And they dramatically brought up inflation. Listen, that is something that will, the economy, the U.S. economy particularly, is the most flexible, self-calibrating economy in the world. And I think you're going to see that. You're starting to see that transmission through the economy today.
And yet, as you point out, there may be some good news in here that some of the middle and lower income people are gaining the most right now.
So, I mean, this is, you know, I think it's a very easy answer. And quite frankly, I don't think it's a complete answer when people say, gosh, the Fed's just got to keep raising rates and do it quickly. You got to be really careful. If you think about what's happened the last few years, wages are moving up. You're bringing more people into the labor force. By the way, there's 2 million or so less people in the labor force today than pre-COVID. You need to keep cultivating that. And this is where I think when you look at this chart, I mean, look at how well lower and middle income is doing now. You're seeing explosive wage growth and people coming into the workforce. That is something the Fed wants to keep going. And particularly think about the income burden in this country, or I should say the debt burden in this country. And we're going to have to fund an awful lot of debt over the coming years. Fed's got to be really careful. A, if you lift interest rates too much, that debt burden is going to be too high, and B, you want to keep lower and middle income wages up and keep bringing people into the labor force. So I just don't think it's as easy as some people say. It's like, we got to get rates up. We got to get them up quickly. We got to reduce the balance sheet quickly. I think we're far from neutral. Fed needs to move away from easy policy, which is, I mean, think about the irony. QE was happening last week, and now we're going the other side. They've got to move quickly away from that. But I just think projecting out where we're going to be 6 months hence on the economy, I just don't think that that's as easy as people suggest it is.
So, Rick, you're responsible for investing an awful lot of money there at BlackRock. I have to ask you, how are you taking into account, if at all, the war in Ukraine? Because it looked to me this week like the markets almost said, well, we're going to react for a while, but sort of we're over it. We're back to saying it's business as usual.
So, Dave, first of all, I would say this is the most extraordinary weeks in markets I've ever seen. I mean, so by the way, the news, not as the Ukrainian news, you had a more hawkish Fed, and then the markets just, I mean, particularly the equity market, just went right through it. Now, some of it is rates stabilized. That was a big deal. Part of it is people have been sitting on the sideline. The losses have been significant this year, both in bonds and stocks. So people were on the sidelines. They're sitting on a lot of cash. And then, you started, okay, maybe I can start to put some money to work. And that started to build on itself. And listen, there was one significant piece of news this week that should not be underestimated. China, the world's watching how China is going to align with Russia or not. And there were some significant statements, both on the regulatory side, on the growth side, but also somewhat what clearly appears to be some detaching between China and Russia. And that was one of the things the markets were super concerned about, because that creates a framework that's really hard to deal with.
Bless you, brother, for raising it, because the other question I had was China, because some people think that maybe President Xi capitulated when it comes to some of the regulation on big tech and some of the issues with really seeking investors from outside of China.
Yeah, I mean, listen, it was a pretty strong set of statements. I mean, I was actually blown away by how aggressive these statements were. I think there's a couple things to talk about here. One, right. Chinese economy has been slow, right. and you have the lockdown in some of the cities, Shenzhen, et cetera. Right. That has created some concern. And then, right. A lot of pressure, I mean, immense pressure on some of the markets there. So, listen, I thought it was a pretty strong statement, and I think that's part of what the markets latched onto this week.